Fed's cut rates by 1/2 point, but things seem to be getting worse. What gives? Let's find out. Yes, the Feds cut the federal funds rate by 1/2 point back on September 18th, but ever since then, mortgage rates have seemed to increase and are still increasing. What the frick, right? I mean, what's going on? Well, Friday's jobs report was strong and we saw revisions and improvements to previous months as well. Unemployment was a little lower and wages were higher. So in short, all this is pointing to a resilient and pretty strong economy and market. These reports seem to contradict why the Fed cut 50 basis points in the first place. Remember why they did, team? They saw a weakening economy and wanted to help improve it by lowering the federal funds rate. Now, hot take here, I believe if the Feds would have had this data before the previous rate cut, they would have not cut interest rates at all, which is wild, team. More jobs, better wages, lower unemployment is all great news for America and the economy, but not great for housing and mortgage rates. It really is a fascinating but extremely frustrating tug of war to witness from a housing professional perspective. Now, a couple things to keep in mind, and this perspective is very valuable for today, so listen up. We shared this on our 20-minute deep dive a few weeks ago. Look what actually happens to mortgage rates the last 3 times the Fed cut rates. Each time there was a run up initially, and then rates fell later. We will most likely see this trend continue this time around as well. Now, the rate prediction game and being an economist in general is really hard these days, so give them some grace. Post-pandemic and post-QE and QT, this stuff is really difficult to call. I mean, look at the Fed. I honestly don't think they would have pulled the trigger on the rate cut had they had this data that we discussed previously. And these are the brightest, or at least supposed to be the brightest economic minds in the world. So if they're getting it wrong, and give everyone else a little bit of grace. Now, with that in mind, I do believe the long-term trend is lower for rates. Let's also keep in mind this interesting fact. There were 21 interest rate cuts conducted by the global central banks in September. That's the most since April of 2020. Outside of the pandemic response, this is the 3rd largest month of monetary easing since 2008. So globally, pretty much everyone else sees a weakening global economy. Here locally, the housing market is softening. We've talked about this a lot lately. Homes are staying on the market longer and inventory is climbing. Rates will have to come down eventually to properly address this, which is good. Remember, rates never go up in a straight line and they also never go down in a straight line. And when rates do come back down, I don't believe it'll be a huge decrease like we saw in 2020 or 2008 or other previous lower rate environments.
Actually, are you subscribed yet? It's quick, easy, and free, and gives you plus 500 aura. So let's hop back into it.
This time around and for 2025, I believe it will be more opportunistic. Little pockets of opportunity that we'll need to be ready to pounce on and take advantage of for our clients. I mean, look at these little moments of opportunity. They don't last long and everyone involved needs to be ready. I don't think it's going to be an entire year of lower interest rates in 2025, rather just little pockets of opportunity. There will be opportunities just in little windows like we are showing here, just little dips in rates as heightened by the little green smiley faces here, which means home buyers and families looking to refinance need to be ready to go before the opportunity hits. Because as we've seen, they don't last long. The housing professionals that will win in Q4 of 2024 and all of 2025 will be the ones that understand this and change their business accordingly. Are you ready?